Hi, everyone, and welcome to today's webinar, Solving an Unconventional Problem, brought to you by 3ESI. My name is Jeremy Green. I'm the Manager of Global Marketing here at 3ESI. And with me today is Alex Inez, who's a business consultant and one of our experts here at 3ESI as well. So before we get started, I just want to go over a brief overview of 3ESI. 3ESI is a world-leading provider of solutions for integrated business planning and operations in upstream oil and gas. We have over 75 installations worldwide, and our products and solutions are currently deployed in 40% of the world's top 10 integrated oil and gas companies. 3SI provides services, software, and consulting for upstream oil and gas. And in fact, our entire company is 100% devoted to that market, the upstream oil and gas space, with solutions for integrated business planning, integrated activity planning, and everything in between. Our solutions are solving problems today in plays around the world that are unconventional, conventional, offshore, and onshore. We're very excited to be able to deliver this webinar to you today, which will be covering an unconventional case study in the US. And with that, I'll hand it over to Alex, who will take you through today's webinar.
Thank you, Jeremy. Again, my name is Alex Inez, and I'm a business consultant for 3ESI. My role is to support the sales department and to also promote the value of our products here in the U.S. and around the world. Today, we will look at a case study based on a U.S. oil and gas company that is primarily focused on assets in the Bakken. The company operates 3 assets. We have 1 asset in North Dakota, which we will call Field A, 1 in Montana, or Field B, and 1 in South Dakota, or Field C. Due to their different operational environment and production constraints across each of these assets, all of these individual fields present their own unique challenges for business planning. Now, our company has one overarching planning objective, and that is to make the best capital allocation decisions across these 3 assets with the goal of maximizing the return on their investment. And in order for us to achieve this goal, we will need to optimize a field development plan for each of the 3 fields and gain visibility into the trade-offs they will need to make across each. So now that we have given you a painting of where we are headed, we will now take you through this case study using our solutions, namely esi.manage and esi.schedule. We will first latch onto esi.manage and then onto esi.schedule. Let's start with Field A. A little bit of background about Field A. This is a relatively new field in North Dakota. They're currently operating 1 drilling rig, but management has asked to see a plan which shows what they could achieve if they were given a 2nd rig. They only have so much facility capacity allocated to their production, which limits how much they can drill at a time. Now, this field had been primarily using a spreadsheets as their planning tool. With Microsoft Excel, they actually capture type wells data, and then they replicate it using various formulas to build out a plan. However, the Excel-based plan has grown out of control, as complex Excel formulas, macros, and other codes are requiring a lot of time, and these people are spending so much time just trying to maintain and troubleshoot this model. With 3ESI's management software, this data can be imported directly. So allow me to introduce you to esi.manage. In this section of the demo, we will look at how Field A challenge is to determine whether adding a 2nd rig is a better investment than continuing with their 1 rig development plan. So the first thing we're going to do is we have our Field A portfolio here, which is empty. Using our Excel data loader, we will go ahead and import into esi.manage in just a matter of seconds these different type wells. There we go. All right, so we just imported these 3 different type wells into esi.manage, along with the production, the capital expenditure, and the operating analysis associated with them. Now, these analyses that you see here on the bottom are very flexible. In fact, they allow you to change some of the data set or parameters here and display the information in different ways. For instance, you can change the granularity of this and perhaps display it on an annual basis. Or you can go ahead and group by state, product, different options here for you. Additionally, if we minimize this chart, then we get a table with all the data that is associated with this drilling activity or the production for this particular case. Let me go ahead and minimize that for you. So now that we have captured these three type wells here, allow me to introduce you to Easy Schedule. Because what we're going to do now is we're going to import those type wells into Easy Schedule, which I took the liberty of doing before the demo just to save some time. Now allow me to orient you so that you get familiar with this screen. This is Easy Schedule. Easy Schedule sits beside esi.manage, and with this solution, we will schedule your inventory out automatically with constraints acting on your projects. As you can see on your screen here, we have the three different type wells and the inventory for each type available. Here we have the schedule information. We have the cycle time showing how long each one takes to build. We also have a max count of drilling activities listed here. And on the bottom, we have our different reports, which show a live performance of what we schedule up here. So what we have here is an oil production, NGL production, your rig chart, and your capital expenditure. Now I have configured three constraints in Easy Schedule. We have a constraint for the oil production, and that is 15,000 barrels per day. We also have a 1 rig and a 2 rig constraint. So what we're going to do now is we're going to schedule this inventory out to see our oil production, NGL, and our capital expenditure with 1 rig constraint. So that's how the profile will look like. Next, we're going to go ahead and schedule this. Notice that I'm just doing this as a matter of seconds. Without a tool like this, this could take you weeks, if not months, to plan. Now, this is the 2 rig constraint. So, of course, a much more rapid ramp up here with the 2 rigs constraint. Now that we have those two scenarios, we can go ahead and export this back to esi.manage, where we can actually run some economic analysis. So we have our 1 rig scenario here, along with the production, capital, and operating expenses. We also have our 2 rig scenario. There we go. And I like to go ahead and run economic analysis on this, which I already quickly did before the demo to save some time. And these are the results of our economic analysis. If we take a look at this 1 rig versus 2 rigs, we can actually take a look at it on a cum basis. They're pretty close to each other. We can discount it. We can say I want to look at my after tax and before tax and quickly visualize that information. Many options here you can choose from. You can take a look at the capital expenditure, net income, production, do combinations of many of these. But I also like to go ahead and cover some of the tabs up here. I like to start off with the summary tab here, which is just a nice summary of this project, where you can see your revenue, your capital expenditure, operating expenses, royalty, taxes, reserves, even your discount rate here. We also have a very nice and very traditional view of an income statement showing your sales volume, your revenue, your operating cost, your net revenue. And by the way, all of this information here can be easily exported to Excel. And last but not least, we have our cash flow tab. Now, this tab has all of the cash flow calculations, as you can see on all these columns. And by the way, these columns here are very flexible. We can configure them and reorder all of this to display the information that you're looking for. Or perhaps you don't like to see some of this information, you can just move it to this column here, and that way it will not be displayed. Additionally, we can expand this and take a look at a very detailed, all the way down to a project level, where you can go ahead and see, again, the cash flow calculations after tax, before tax, for all of these projects here. Now, if you take a look here on the bottom, this is our metric analysis. So what is this telling us here? If we look at our before tax NPV for the 1 rig scenario versus the 2 rig scenario here, we can see that the 1 rig scenario is a better investment. Now, just to summarize what we just did, we have run an economic analysis of the 1 versus 2 rig scenario. And based on these results, we can now determine that in today's lower price environment, and given the fact that the facility constraint is preventing full utilization of the 2nd rig, the 1 rig scenario remains a better investment. So in this particular case, the 1 rig definitely offers a better economics in the long term. Let's go ahead and move on to Field B. So over in Montana, Field B does its economic planning areas. The team has input each of their well locations into areas as an individual case, and they have a little bit over 100 locations identified. Now, this team, however, struggles with being able to align these individual well locations onto the drilling schedule, as they're managed by 2 different groups, and they're constantly falling out of sync and having to reconcile. And oftentimes, management will ask the team to look at different capital investment scenarios. For instance, management could ask, what could you do with more capital? Or perhaps with less capital? What are the implications? Well, in this particular case, management has requested that the team looks at what they can do to reduce their capital spend by 25%. Now let's go back to Easy Schedule. We're going to go back to our projects perspective, and we're going to go into our areas data portfolio. Notice that it's empty. What we're going to do now is we're going to use our areas integration tool to go ahead and import these areas cases. So right now, we're loading all these well locations, and when we load this information, we are actually reading the inputs that are entered by the engineers, such as the formulaic information, capital expenditure, operating expenses, and the like. As all this info is coming across, as you can see now, we can recreate cash flows in esi.manage. And one of our key differentiators among other tools is that other tools can only read the output and not the input. But in esi.manage, we actually read both. We read the input and the output. Also, the tables that we read from in Aries are 2 tables. One is the AC property, and then the other table is the AC economic. And this process is finishing up now, just a matter of seconds before we can take a look at all these cases. There we go. It's completed. So let's go back to Aries. And we can see now that we have just imported 150 Aries cases and the resulting production, capital expenditure, and operating expenses for the plan and this analysis view down here. And I would like to highlight the fact that we have just imported all of these Aries cases into esi.manage in less than a minute. Now let's take a look at some of the projects that we just imported. Now all of these are unique individual projects. And if we take a look at some of the details here, we can see that all of them are in Montana. And the project type for all of them also here is drilling. Now, just as a quick note here, I'd like to show you how you can actually access relevant data across a large data set. And you can do so very quickly in esi.manage. Now, let's say that right now you're wondering what your projects are in Montana. We can quickly drill down here and go to Montana. And let's say we want to find out how many projects we have in Dawson. So if we drill down and select that, then we see that we have 18 projects in Dawson here. The production, the capital expenditure, operating expenses, everything also updated on the fly to reflect these 18 projects. And the value of all this is all the data that we capture within these projects. I mean, within each of these projects, we're capturing all the production, all the capital, all this data you can look at microscopically. I mean, this is definitely the backdrop of esi.manage. Now, in order to answer management's question about reducing our capital spend by 25%, we will use our ranking capability. So let's go to ranking. So what we're doing right now is ranking all these ARIES cases against one another using a few metrics that are important for our company here. So we have configured 4 metrics. Some of them are operational metrics, such as the net capital, full life net production. We have some economic metrics, such as the NPV. You can even create your own metrics here. Let me go ahead and turn on this color scheme view. It just makes it easier to identify which ones are the best performing and the worst performing projects. We have the ability to also sort by a score here. So the higher score are our best performing. And if we scroll all the way to the bottom here, our worst performing are the ones in red here on the bottom. And notice also that many of these right here have a negative NPV, and these were not good investments to begin with. Next, I'd like to go ahead and show you this ranking summary down here. And what we see here are the same 4 metrics that we had listed up there. Now we have your low, your high price, your total. Since management asked us to reduce capital spend by 25%, then our target is $770 million. Now, what I can do is I can come down here and I start with these poor performers and turn off these projects. Now, notice that as I turn a project off, my total decreases. So my goal, let me just multi-select a few of them. There we go. Now, this is actually pretty close to the target. So what we have been able to do in a matter of a few minutes is to identify our best performers. Now that I have done so, what I like to do is I like to create a ranking project set. And this is going to preserve this new set by saving it so we can run economic analysis. Then we can compare the plan before and after cutting the 25% of the capital as management instructed. Let me quickly go ahead and create a project set. I'm going to call it after ranking. If you take a look at this navigator window, that's where they go by default. So I have my before ranking and my after ranking set, and I'm going to quickly run this analysis so we can look at the economics of it. Notice that this is a very powerful engine also. Just within seconds, we're running economics for 601 cases right now. There we go, and we're going to get our results in just a couple of seconds. Here we have them. Now, I already covered all of these steps here, but what I like to showcase now is that down here, we can quickly take a look at our before ranking. The before tax NPV we were getting with that was $513 million. However, after we reduced capital and we removed those poor performing projects, the after ranking before tax NPV is actually a lot higher. We have almost $754 million here. Definitely, this allows us to see that the after ranking was a good decision and is actually the better investment. Let's go back to our main screen here. And what I'd like to show you now is our resource planner. Now, because we just ranked these right in economic analysis, so what we want to do now is to schedule them, and that's what this resource planner tool is good for. You could say it's one of the added benefits of using esi.manage. So all of these projects that you see down here, let me go ahead and zoom in. All of these projects that you see down here are currently unallocated. So we see our rigs here listed. Let's go ahead and add a little more rigs. We can create different what-if scenarios, reducing the number of rigs or increasing the number of rigs. But basically, if I were to explain this in a nutshell, we can use this builder, what you see down here, and basically automatically allocate all of the projects that you see down here onto the various rig lines. And this will ensure that the resulting plan is not only financially, but also operationally feasible. One thing to keep in mind also here is that if you take a look at each of these rig lines or resources up here, they're under different contracts, and they're available for different periods of time. What you see here in orange means that this is not available during these times. So we can now go ahead and we'll try to build this and have esi.manage assign these rig schedules here. So now, as you can see here, we have assigned these to the different rig lines that we have. And once again, this is very flexible. You can add the number of rigs here, you can reduce the number of rigs, but basically we have gone ahead and scheduled all of this using the different rig lines that we have. Now let's go back to our project set here. What we're going to do next is we're going to move on into our Field C plan. A Field C, it's actually in South Dakota. And just a little bit of background on this field is this program is actually fairly cookie cutter, if you will. And they use more of a top-down approach for developing their business plan, as opposed to a more of a bottom-up approach used by Field A and B. Now, each of the pads here consists of 4 wells, and they use these pads as the standards. So when they're modeling their pads, they know they can repeat these pads and build this plan quickly. This Field C, at the time, right now, is also experiencing the same teething problems as Field A and B. And this is mainly because it still has to deal with the technical difficulties or complexities that the other fields are actually going through. However, Field C is doing something different. In fact, Field C is choosing to take a different approach. What they're doing is they're making some simplifying assumptions and leverage the power of esi.manage type curve capability. And they're doing this to make their business plan modeling more flexible. And that's the key. Now, from a technical perspective, here are some more details on this plan. As you can see, once again, each pad consists of 4 wells. Each well takes 20 days to drill, where one drilling rig moves from one well to the next. And following the last drill, the wells are all completed simultaneously using a multi-stage fracking technique. The wells also use the same middle Bakken production type curve. Then Field C planning team, what they can do now is they can create a plan simply by changing the count of how many well paths they want to configure. And what we're going to do now is, if you see down here, we have 120 wells, and I apologize, it should be 30 here, because what they're doing right now is they're contemplating repeating the pattern 30 times. But we're going to do, actually, this is good, because we're going to create 2 scenarios. We're going to repeat the patterns first 30 times. We're going to look at the metrics to check our NPV, and then we're going to actually repeat the pattern 40 times. We're going to see the difference in our NPV and realize which one is better. So great, let me go ahead and go back to esi.manage. And by the way, so if we first do 30, then we're talking about 120 wells being drilled and coordinated. All right. The first thing I'd like to show you is this type curve components. Now, these you could say are the type curve building blocks components that we will use. Now, if we briefly go over them, we can see here we have a unit drilling cost, which is a capital expenditure. Then we have a frac stage completion cost, which is also a capital expenditure, but instead of being by day, it's actually in frac stages. Lastly, we have the production profile associated with the Middle Bakken. Now let's go ahead and drill down to our Field C project here. Let's go to a type curve. So let's begin with the drilling unit cost. Now, in this example, we're going to build the 4-well pad. And the count here, it's 80. Remember, we said that it took 20 days for each of the 4 wells. So that's 80. So as we do that, down below, also take a look at this 4-well pad development graph here, because it is important. The timing of it is very important. If we look at this right now, we're spending $60,000 per day. Now we're going to go ahead and add a frac stage completion cost here. Now all 4 wells are completed simultaneously, we said. So we have 20 frac stages and 4 well boards. That equals 80. There we go. Last, we will add a production profile. Middle Bakken oil. That way, that's going to give us our production profile. Now, notice my curve here, and from here starts declining. But we said that it was a 4-well pad, so we need to scale this by a factor of 4. And there we go. And that's our profile. So what we just did, we have just built a pattern. This is actually a single instance of this 4-well pad. But what we're trying to do is we're trying to develop out the field, and we can repeat this pattern. We said we were going to do it first 30 times. So let's change this to 30. And that's how our production looks like. And if we take a look at our metrics here, and by the way, every time I click on the metrics tab, you see a calculation going on in the background, because this is actually a live performance of this project. So every time or every change we make, every time we click on the metrics, it will recalculate. So with the 30, if we repeat this 30 times, this occurrence, we have an NPV of $2.2 billion. So what happens if we actually have 40 occurrences as opposed to 30? Take a look at our metrics. It's going to calculate in just a few seconds. So we can find our NPV. The NPV with 30 occurrences was $2.2 billion. So the one with 40 occurrences is actually $2.8 billion. So what we can say about this model is that it provides this team with a very small number of items that need to be updated. And those items are, as we saw, the type curve and the individual project. But then it also provides them with a tremendous amount of flexibility to adjust the scales or the production profiles and quickly reassess this opportunity over and over again. So what we can do now is we go back here. Let's change this back to 30. And we can run economic analysis of these. Let's go ahead and do that. There we go. So here's our economic analysis, and just within seconds. Again, very useful, very meaningful information for you to make a sound decision. And this one has the same as we did before. All these tabs here are available at your disposal. But now we have covered Field A, Field B, and Field C. So all of this information from each of the individual teams, we're going to bring them together. Let's go ahead and go back to our main screen here. So we brought up all this information from different sources. We brought them from Excel, we brought them from Aries, and we also had some information in esi.manage. So all this data, as you can see right now, we have 202 projects has been rolled up to provide management with an overview of their organization across all fields. And from here, management can actually conduct further analysis. The good thing is that they know that all of this data can be rolled up and compared consistently. And this is a challenge that they currently have when they reconcile multiple sources, systems from before. And the value of all this is that now management can do apples to apples comparisons of all the data. So we're going to go ahead and report on all this data. I'll just go ahead and show you a few examples of some of the reports that we have available for you. We have 30 canned reports at your disposal, and these reports are very flexible. What I have here are just representative examples of some of the reports that we use. The first one is a production wedge report. You can see here the years, but we also allow you to build your own custom charts. You can build these charts here and select the different chart types. You can have a line, a bar, a pie, you name it. Very flexible. Now, let's just go over this capital expenditure report. Now, this capital expenditure is for the whole management roll-up, and it's from the year 2015 until 2020. We have the information here on a yearly basis for the 3 different fields. We also have a nice graph associated with these numbers. You can choose to either display or don't display this graph. Additionally, all of this graph and all of this information can be exported to Excel, PDF, HTML, many other different formats. And when I mentioned that these reports are flexible, is because we do give you latitude here to change some of the information here. What if you want to display this on a monthly basis? And under grouping here, what if you actually want to display it or break it down farther into capital expenditure type? Let's go ahead and do that and see how the reports look. Now, within seconds, we see the information where we want to see. We broke it down by month here, and we have our different capital expenditure types here, our completion, our drilling. Very flexible, very useful information here. We have production reports. We have operating report, operating expense report, lifting cost reports. And the last one I like to show is one of the 30 that we have available, is the production by product. Here we have a breakdown of our oil, our gas, and our NGL by year, by field. And then we have our pie chart associated with it. So that's just to go over briefly over our reports, but I would also like to demo how different business intelligence tools such as Microsoft Power View and Power Map can easily connect to this esi.manage reporting database. And ultimately, this will provide management with reports, dashboards, pretty much all their reporting needs. Also, all of this information gets refreshed with new planning data whenever the teams provide new forecasts. Some of the examples that I have to show you today are, once you export all of this information, you can just go ahead and select different cash flows results here. For instance, we want to take a look at our after tax, our before tax. We have our field A, and quickly display that information, field B, and field C. Now, we can create this real quick, and just within seconds, we're going to have this, using Power View, a nice graph displaying all the capital expenditure, the operating expenses, production, before tax and after tax for each of the fields. You can actually isolate these and show which one to focus on. And the last thing that I like to show, and something that actually right now is being used significantly in many other companies, is what the Microsoft Excel released, the Power Maps. And these Power Maps will also allow you to present this data to management in a very graphical, very interactive way. And the way we do this is basically by simply using this Power Map. So the after tax and the before tax for field A and B, I went ahead and plugged that into this. And this is the information that the final information that Power Maps will give you. So you can display this information and easily show this and say, this is my after tax in Montana, this is my before tax, this right here is for the state of North Dakota. And you can just drive around the globe here and display information that you want. For instance, it could be your revenue or it could be your production. So very, very useful tool, a business intelligence tool that is available for you once you export that information from esi.manage using our reporting database. Now, we have also, in many cases, many of our clients have different sensitivities scenarios. And one of the common ones is to run a scenario of a high price versus a low price. So allow me to show you how we can easily do that in esi.manage. If we go back to our projects perspective here, we have a price scenario here. We have a high price and a low price scenario. So if I quickly go ahead and run that, and as the system is crunching these numbers, you can tell it's performing some rigorous calculations here in the background. But within a few more seconds, we're going to see our results. Now, the good thing about this high versus low price is that once we get the results, we can show this to management, and they're able to see the economic analysis across all the assets. And they're also able to see the analysis given the different prices scenario and be able to make a good decision as far as going with the high price or the low price. So this is almost over now. Let's go ahead and take a look at the results now in our analysis view here. So now we have our results. This is my high price versus low price. Again, you have the ability to drill down. But what I like to display here is this variance capability here. That's what they call incremental economics. And basically, I want to find out the delta between my high price and my low price. And I can use a reference table here. So this is my high price. The difference between the high price and the low price is this right here. Or if you prefer, you can have a low price reference table here, and you'll get the information displayed. And as usual, on the bottom here, you see your high price versus low price, before tax, NPV. And in this particular case, we're getting a higher, more significant higher actually, NPV for the high price. So having said that, now I'd like to hand it back to Jeremy for the conclusion of this demo.
Thank you, Alex, for delivering the webinar. We'll open to questions. We had one question sent in during the webinar, and Alex, if you don't mind, I'll ask that one right now.
Yeah, go ahead.
So the question was, you never mentioned any fiscal regime concerns like different severance or ad valorem taxes for each state. Do you incorporate those taxes into the economics?
Oh, absolutely. We do. And what we do in esi.manage, what we do is we configure all of these, the different severance and ad valorem taxes for each of the states. In this case, we have 3 states, North Dakota, South Dakota, and Montana. So we would actually configure those for each of the 3 states. And that way we can set up models for any other states that they need for the fiscal regimes. And that's very easy to do. And the way we do that is in the configuration screen. This is where we actually configure a lot of the price scenarios, forecast profiles. And so we do have that ability to do that, yes.
Okay, thank you. So with that, I want to thank everyone for joining us today. And please look forward to our next 3SI webinar. You can find us on LinkedIn or just visit our website, www.3si.com. Thank you very much.
Thank you.